Good morning, ARMR Insiders. Welcome to the morning call. Thanks for joining me. Hope you had a good day yesterday since I was in and out of the office. I wanted to take some time this morning before we get into our usual setup of what we want to buy and what stocks we may be trading this morning, a couple of which are popping off right now. Before I get to that, I want to share with you some key components of the ARMR Investing Way to kind of reiterate this. And I want to do this periodically with you. And as you can see, I started this video off with a picture of ARMR Education Series, because what I want to do is put these together and we can watch them whenever we need to refresh. So the ARMR Investing Way is a process I've created over 30 plus years of doing this. It's fundamentally driven with fundamentally built, algorithmically driven, right? So we have a three-stage process. We build our whiteboard. There's our fundamentals. Then we use algorithms for our execution process. We use stop losses to tie it all together and protect ourselves. That's the three-stage process. Very simple. It's not that hard to make money in the market if you can follow the simple process. And let me tell you something. I struggle with following it every day because the process is not what the human mind wants to do. The human mind is driven by greed and fear, and we fight that every day. And the whole purpose of an algorithmic approach is to extract those performance killers, get rid of them, and just execute a strategy where we've proven to ourselves over and over and over again, every single time I optimize strategies, algorithmic strategies, and run through an exhaustive, enormous progression of possibilities. I'm going to share with you the gems, the gold that comes out every time I do that. There are specific performance enhancing, drugs for the portfolio that work every time. Every time I optimize an algorithm, and I've been doing this years, but I still periodically go back over these key issues to see, has anything changed? Has the market changed? No matter what kind of market it is, these rules improve the performance of the strategy. And quite frankly, they'll improve the performance of any strategy. So here we go. Here are the key issues that I just want to recommit myself to. And I hope perhaps you learn from this, right? So again, this is my strategy. I'm sharing with you what I do, fits my personality. You got to make your own choices, risk tolerance, goals, and all that stuff. Okay? But I'm going to share with you analysis, building algorithms that shows us highest probability of success versus risk, right? Reward versus risk. So when the probabilities are in our favor and reward is worth risk, that's when we take a position. That's how we increase net worth over time. And here's how we do it. Here's a couple of key factors, and I wrote this for you over here in Captain's Log. So you guys can go check it out today if you want to, you don't have to write this down. You can see what I've written right here, okay? But step one right here, buy as close to the stop as possible, never pyramid, okay? This is key. And I've learned this rule myself. I never pyramid, okay? I buy a position and I admit to myself, even if I do a position size that's not right, it's too small, the thing blows out, I'm not chasing it, right? So rule number one, if you could just get yourself to do this, your performance will improve. You put the largest position size on at entry. You do not chase as it goes up, okay? The step two is the position size. Okay. When I say the largest position size at entry, here's an example. There's two things in this, there's two pieces to this thought that you really want to try to master. Number one, you don't tiptoe in. When you get the right entry trigger, closest to the stop, you put your biggest amount of capital to work, whatever that is for you. Maybe 5% positions are your maximum position size. You have 20 positions in your portfolio. Okay, 5% goes to work the day of the entry. Now, it may be smaller for a small cap stock, right? So that's the only caveat to this rule. So there's a position size for big caps that's max, and there's a position size for small caps that's max, right? Small caps are more volatile. Maybe you want to do that. Maybe you don't. There's a good argument that you shouldn't do that. There's a good argument that every position should be the same size. And I'm going to get to that in a minute. Okay? But let's just say that you want to take position size as big cap 5%, that's maybe small cap 3%. Okay? The day one is you put that capital to work. You don't cherry pick which position should be the biggest. I can't tell you how important this is. I've learned this the hard way over the years, and I want to try to save you this pain. In some weird twist of fate, if you cherry pick your ideas, so you got your whiteboard, you got the risk on algorithm that tells you now's the time to put money to work. You put the money to work, but you say, hey, I like this name on my whiteboard better than that name. So I'm going to make this one bigger and that one smaller. I guarantee you, your biggest size positions will go down and your smallest size positions will skyrocket. I don't know why that is. It just is. It just is. It's a frustrating, strange twist of fate. So take that frustration out of the equation and make every position size the same. Then your fundamental bias won't ruin a good portfolio. Let me say that again. Your fundamental bias won't ruin a good portfolio. Okay? You put 10% into the one name you think is the greatest, and everything else is 3%. That one 10% position implodes. All your 3%ers do great, and all they do, all the success of those 3%ers gets wiped out by the 10%er that you thought was the greatest idea ever. Please don't do that. Save yourself that pain. Okay? Just make them all the same size. Now, the reason that you want to put all your capital, your position size to work, not all your capital, but the biggest position size on at entry, is because of the way we execute stops. What we want to do is have a portfolio full of winners. The strongest relative strength names. Okay? Our stop loss discipline is to cut the loss. I'm going to go over the stops in a minute. But primarily, the best stop loss every time is the low of the bar that we bought, or the low of the day that we bought, for swing and investing purposes, the low of the day that we bought. That's the stop. So you put position on. If it goes below the low of that day, you take the position off. I'm going to go over with you how we do this in a minute. But the reason you want your largest position size on at entry is because the stop is very tight. And here's the thing that you can take to the bank. Your successes never challenge the stop. You buy them, they skyrocket. You buy them, they start inching up, inching up, inching up. They never challenge the stop. Your losers always challenge the stop. By definition, they're going to be a loser. And your mediocre positions challenge the stop. Maybe they turn around and go up, but they challenge the stop. So what we want is our biggest position sizes on at entry that skyrocket, and everything else we're taking out of the portfolio. You might put 10 positions on, 10% each. You want to get stopped out of, I don't care if it's 5, like this. I don't care, because the other 5 never challenge the stop and skyrocket, and the net worth of your portfolio goes up. You don't have to be right 9 out of 10 times. You have to cut your losses correctly and ride your successes. And you have to make sure your successes are big enough, right? You don't want to have a lopsided portfolio where your losses outweigh, because of the position size, your successes. You with me so far? Okay. Let's go to stop losses. The low of the day we bought it. I can't tell you, I've been managing money over 30 years. I've been writing algorithms for 15 years. in one form or another. And of course, in a more aggressive way, I'm really committed to algorithms probably in the last decade. Every single time, I don't care what the algorithmic trigger is, right? Your entry trigger, whatever the entry trigger is, every single time I search for the right stop loss. I started by doing the O'Neill way. Maybe it's a 7% loss, a fixed percentage. Maybe it's a floating percentage based on volatility. Maybe it's a moving average. Every time I mess with it, there is not a single stop loss that performs better than the low of the day I bought it. And here's something you got to remember. If you put a bunch of positions on and they all hit their stops and you say to me, Brett, this doesn't work. I'm getting stopped out of everything. I submit to you, it's not the stop that's wrong. It's your entry trigger. Work harder, be more disciplined to find the right entries. Okay? Every time I do the analysis and I crunch the numbers and I optimize the strategy, low of the day I bought it is the best stop. The second best stop is low of the move we're buying. Let's take this to a chart so you understand what I'm talking about, because this is critical. Okay? Let's look at Novavax from yesterday. Now, we didn't buy it yesterday, but I told you could increase the position here if you wanted to, because this is the real breakout. This is not pyramiding. This is the real breakout. We bought it early. We should have been waiting to buy it yesterday, quite frankly, but I just didn't want to pay up for it. Okay? But look, let's pretend yesterday was the entry day, because there's your reverse head and shoulders and a breakout of the neckline and it's gone. Okay? You could argue maybe September 2nd was the entry day. You could argue that. And I can go over this in future videos of how I determine my entry day. We're gonna talk about that in another video. We'll go over what is the trigger, okay? But for today's purposes, let's say yesterday is the breakout day. That's day one. That's the day to buy Novavax. So the low of yesterday is going to be the best stop. If this breakout's real, it's never going to challenge that stop. Novavax is going to turn around and skyrocket, and we're never going to have to worry about it. The second best stop is going to be the low of the move we're buying. And this is a little artistic, and it'll take time for you to learn how to do this, okay? And you could be off by a day or two. It's not going to ruin your strategy. But basically, for me, in this particular chart pattern, it's the day that the stock closed above 260. 250, okay? The day it closed above 250 was this day. That's the day I was looking for. We actually bought it right in here. It breached 250, went down. We paid for it right in here. It challenged us a little bit because we didn't buy it right. And then it popped above. This was the day to buy it, actually, when it popped above 250. So either you buy it yesterday on the clear breakout day, and you use the low of that day as your stop, and you use the low of the move you're buying. The move started the day it went above 250. So that's the low of the move you're buying. So stop one is LODB, stop two is LOMB. Okay? And so it's okay to use the two stops. You cut the position in half if it goes below the low of the day you bought it, and then you cut it out if it goes below the low of the move you're buying. The reason this works, first of all, is it's naturally going to skew your portfolio towards your best positions, because your best positions, assuming a 5% position, the ones that never challenge LODB are going to skyrocket. So your position's going to be overweighted in the most successful names. The other ones will be cut in half at 2.5% position sizes, and they might work and they might not work, but they'll have less of an impact on the portfolio. Okay? Ideally, what you want to try to do is this. Okay? You want to buy when LODB and LOMB are the exact same thing. And on DraftKings, we did that. Okay? And you can tell the difference. You know exactly what I'm talking about. The thing broke out, pulled back, and right there was the buy day. Bing, it popped up. We bought it. And look how it never challenged the stop and it keeps running. That's ideal. You want to buy the LODB and the LOMB are equal. Okay. Those are my thoughts for the morning. And I just wanted to, so go take a look at that if you'd like. You could see what I'm talking about, and I wrote them down for you. All right. Real quick, and then I've got to go because I've got a bunch of things happening at the house today. So I'm going to be taking care of some business, coming back, getting the live trading desk started for the morning. Here are a couple of things top of my whiteboard. FUBO. Aries just listed story that New York is going to be using FUBO or allowing them to use their sports book. So we're still waiting for FUBO to go above 30, right? We haven't missed anything. We've waited on FUBO. And then hopefully what's going to happen here is the stock's going to break out above 30 today and give us a risk on entry point. It hasn't done that yet, right? And we haven't missed anything yet. So I'm going to look to day trade FUBO. NNDM is an old favorite of ours. Anybody on the ARMR Insider Trading Desk knows this. Double bottom, trying to go above this consolidation here. Made an announcement. Honestly, Aries, when I read the announcement later, it's not a, I don't know how this is going to be received. It's not a game-changing revenue type of announcement, but they are hooking up with a very respected research institute, which I think will give them gravitas that proves their concept, right? So it's a company with huge amount of cash on the balance sheet, but no real revenue or income. But this could be like a watershed for them in the sense that it puts them on the map that the technology is legit, it's real, and perhaps it's a reference that helps them make other sales. If the street looks at it that way, then we're going to see NNDM break out today, and we're going to want to own shares of NNDM. And just to give you a quick thought, it trades usually with the rest of the space, and these stocks look pretty good. Look at 3D Systems. That looks pretty good. SSYS. Not bad. Coming off of these huge bottoms. So I'm thinking NNDM can do that, and they've got boatloads of cash and a wily CEO that we like. So there's a couple thoughts for you. I'm still keeping my eye on cannabis, although doing nothing this morning. And so I got to hop here. Any quick questions before I go? No? Okay, good. So that wraps it up for this morning. I'll see you guys on the live trading desk as soon as I can get back to this desk, hopefully before 9:30. Everybody else, of course, I'll see you in the Slack room. We'll be sharing ideas. We are risk monitor yellow. I'm more interested in managing risk. So put a bunch of positions on the last couple of weeks. Now I'm looking for excuses to take positions off that are hitting stops. If we bottom right, the LODB or the LOMB is our stop, we take them out, right? So LODB, if it goes below LODB, I'm cutting positions down, raising cash. Okay? So we'll be monitoring those positions. Oh, Coinbase. Coinbase made an announcement that there was a Wells notice about a subsidiary. But if you read the story, I'm going to post it for you in the Slack room. It's not affecting revenue right now. They're trying to get a new business started. SEC thinks that maybe they shouldn't be doing that, and then there needs to be remedies to how they're doing it. So it's not a game changer. I don't really think the stock is down 3% today because of the Wells notice. I think it's down 3% because maybe Bitcoin's down and some of the other, Bitcoin mining stocks are down. So that's why the stock is off. And maybe they're using an excuse to sell Coinbase, but the Wells notice is not a game changer for the company. So I wouldn't worry about it at this stage. All right. I'll see you guys on the flip side. Have a great